As Warren Buffett once said, investing is simple but not easy. Today we delve into The Little Book of Common Sense Investing by John C. Bogle. This book, penned by the founder of the Vanguard Group, is a treasure trove of wisdom for investors of all stripes. Bogle's credibility is beyond question, having established one of the world's largest investment companies. The essence of this book is a simple yet profound premise. Investing doesn't call for a finance degree or intricate strategies. Instead, it requires common sense. This book is a testament to Bogle's belief that the average investor can achieve their financial goals without getting entangled in the web of the investment industry's complex tactics. It is an invitation to return to the basics, to understand the power of simplicity in investing, a reminder that sometimes less is more. So brace yourselves as we decode the wisdom encapsulated in The Little Book of Common Sense Investing. Chapter 1 of Bogle's book champions Simplicity in Investing. This is our springboard into the profound wisdom of John C. Bogle, the vanguard of sensible investing. His first chapter is a clarion call to all investors, seasoned or beginners, to embrace the power of simplicity. Bogle's philosophy is unpretentious and straightforward, yet strikingly impactful. He argues that investing should not be a complicated maze of financial jargon and intricate strategies. Instead, he advocates for a simple, long-term investment plan that anyone can follow. Bogle's mantra is one of patience and consistency. He champions the idea that a steady, long-term strategy, as opposed to short-term speculation, is the key to sustainable growth. He likens short-term speculators to gamblers, warning that the pursuit of quick profits often leads to financial ruin. Instead, he advises investors to adopt a long-term perspective, to weather the inevitable market storms with grace and resilience, and to reap the benefits of compounded returns over time. Equally important in Bogle's philosophy is his endorsement of low-cost index funds. He argues that these simple, inexpensive investment vehicles often outperform their more complex and costly counterparts. Bogle suggests that the financial industry, with its myriad of complicated investment products, often serves its own interests rather than those of the investor. He warns against falling for the allure of complex products that promise high returns, but come with hefty fees and high risks. Instead, Bogle endorses low-cost index funds as the ideal investment vehicle for the average investor. He points out that these funds, with their broad market exposure and low costs, offer a simple, effective way to achieve long-term financial growth. In essence, Bogle's first chapter is a compelling argument for simplicity in investing. It reminds us that investing doesn't need to be complicated to be successful. It teaches us the value of patience, the importance of a long-term strategy, and the benefits of low-cost index funds. As Bogle puts it, the simplest approach to investing is also the most effective. These words, simple yet profound, encapsulate the essence of Bogle's philosophy and lay the foundation for the rest of his insightful book. They serve as a beacon guiding us towards a future of sensible, successful investing. In Chapter 2, Bogle warns against the pitfalls of chasing past performance. This is a common mistake many investors make, convinced that a fund's past success is a guarantee of its future performance. But Bogle, with his years of experience and wisdom, begs to differ. He argues that chasing past performance is a fool's errand. Why? Well, because the financial market is not a movie that you can rewind and play back, expecting the same scenes to unfold. It's more like a river, ever-changing, its currents constantly shifting. Today's winners can easily become tomorrow's losers, and vice versa. Bogle emphasizes that the future is what truly matters when it comes to investing. It's not about what a fund has achieved in the past, but what it can potentially yield in the coming years. And predicting that, as we all know, is not an exact science. Not even the most sophisticated algorithms or the most experienced financial analysts can guarantee future performance. This is where the importance of diversification comes into play. Diversification, as Bogle explains, is not just about spreading your investments across different asset classes. It's about understanding that each investment comes with its own set of risks and rewards, and balancing them in a way that aligns with your financial goals and risk tolerance. It's about not putting all your eggs in one basket, no matter how golden that basket may seem. Because in the end, the golden basket might just turn out to be a mirage, leaving you with nothing but shattered dreams and empty pockets. So instead of chasing returns, Bogle advises investors to chase a well-diversified, low-cost portfolio that has a reasonable chance of meeting their long-term financial objectives. It's a strategy that might not make you rich overnight, but one that will most likely keep you from going poor in the long run. Remember, past performance is not indicative of future results, a fundamental truth in investing. It's a mantra worth repeating, a beacon to guide us through the often murky and treacherous waters of the financial market. Chapter 3 and 4 introduce us to the realities of time and costs in investing. And so, we delve deeper into the universe of common sense investing. Here we encounter two critical elements: time and costs. John Bogle, the sage of investing, enlightens us on the paramount importance of time. Time is not just a mere chronological concept in the world of investing, it's a powerful ally. It's the secret ingredient in the recipe of compounding returns. It's the invisible craftsman that carves the sculpture of growth from the marble of investment. Think of compounding as a snowball rolling down a hill. The longer the hill, the larger the snowball becomes. That's the magic of time. It allows your returns to generate their own returns. A modest investment today can grow into a substantial sum tomorrow if we give it the gift of time. However, this magical journey of compounding returns can be abruptly halted by an insidious foe: high costs. Just as time can be the engine that propels our investment forward, high costs can be the brakes that bring it to a grinding halt. Bogle warns us about the detrimental effect of high costs on our investment returns. Each dollar paid in fees is a dollar less of potential compound growth. Over time, even seemingly small fees can devour a significant chunk of our returns. It's like the tale of the goose that laid the golden eggs. If we get greedy and try to extract more eggs than the goose can lay, we end up killing the goose. Similarly, if we allow high costs to eat into our returns, we are essentially killing our golden goose of compounding returns. So, what's the takeaway? Be patient, let time do its magic. Be vigilant, keep costs at bay. Remember, investing is not a sprint, it's a marathon. It's not about timing the market, it's about time in the market. Time is the friend of the investor, while high costs are the enemy. Keep these words in mind as you navigate the sea of investing, and you'll be well on your way to achieving your financial goals. In the final chapters, Bogle advocates for the power of indexing. This is where the rubber meets the road. Bogle's endorsement of index funds is not just a passing remark, it is the cornerstone of his investment philosophy. Why do you ask? Well, because index funds are reliable, cost-effective, and in Bogle's view, the best bet for the average investor. What is an index fund, you may wonder? Think of it as a basket of stocks that mirrors a market index like the S&P 500. Instead of trying to beat the market, an index fund aims to match it. Now, this approach might not sound very exciting, but Bogle isn't in the business of excitement. He's in the business of making money, and he argues that index funds do just that. They cut out the middleman, reduce costs, and deliver returns that most actively managed funds can't match over the long run. You see, actively managed funds are a bit like a game of musical chairs. They're all about trying to outsmart the market, jumping from one hot stock to another, all while charging hefty fees for the privilege. It's a high-risk, high-cost game that, according to Bogle, most investors are better off not playing. Instead, Bogle advocates for a different approach. He proposes that we embrace the power of simplicity, the power of patience, and the power of indexing. After all, why try to find the one winning stock in a sea of thousands when you can own a piece of the entire market? And here's the kicker. Bogle's not just talking the talk, he's walking the walk. His company, Vanguard, is one of the biggest providers of index funds in the world, and millions of investors have reaped the benefits. So if you're looking for a no-nonsense, cost-effective way to invest, consider the power of indexing. It's not about being the smartest person in the room, it's about being the most patient. It's about understanding that investing is a marathon, not a sprint. In Bogle's words, don't look for the needle in the haystack, just buy the haystack. So what can we take away from the little book of common sense investing? The wisdom distilled in this compact guide emphasizes 4 key principles. Firstly, simplicity is more than just an aesthetic virtue, it's a strategic advantage. Complex investment strategies often obfuscate more than they reveal. Secondly, we've learned that chasing returns is a fool's errand. The only surefire way to reap the benefits of the market is to play the long game. Patience, not haste, is the investor's greatest ally. Thirdly, the book underscores the importance of being mindful of costs. High fees can erode your returns over time, turning a promising investment sour. Finally, indexing emerges as a champion strategy. By mirroring the market, you're guaranteed a share of its overall success. In essence, Bogle's book teaches us that successful investing lies not in complex strategies, but in common sense. As we navigate the world of investing, let's remember to keep it simple, cost-effective, and long-term.